right. Welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack. It is my joy to be bringing you this show where once again, we are going to be talking about the important information you need to build confidence in your financial plan, in your tax plan, and in your overall financial well-being. We are strong advocates in eliminating the frustration that most Americans feel around taxes, the rising cost, and the stress that just comes with having little money to show for all the hard work that you put in. And so today's episode is going to be talking about a strategy that is beneficial to many people, many Americans, many business owners, many investors, but it's not for everyone. It is not for everyone. And there is a lot of bad information out there about this topic that has cost people quite a bit. And again, our goal is always to decrease the amount of stress you feel. And it's not just decreasing taxes, but decreasing costs in general and making your decisions pay you rather than the US government. And that is all encompassing, right? There are some strategies that I can advocate for that would decrease your tax bill immediately. It would cause you to pay less in tax this year and probably get a refund this year. But because of the overall cost of that strategy in the long term, I might hesitate to give that to you for that reason, because we don't just care about your refund status in this year, but we care about your financial well-being throughout your entire life. I had a conversation with David McKnight once on this podcast. You can go back and look at it. And he talked about how many CPAs in years past would have their clients contribute a massive amount of money into their tax-deferred retirement accounts because it makes them look good in the near term. They get a refund or pay very little in tax that year. But then when taxpayer A, who went and got that advice, when they go to retire, well, the CPA is already retired and he doesn't really care about their financial standing. And now that taxpayer, the person who took that advice and contributed a large amount of money to a retirement account, is paying taxes on that money and the gains of that money. And so it's actually more costly advice. And so we take that into consideration when we work with you on a tax planning basis and when you're a client, and even in the information that we're giving out for free here on this podcast. And so if you get any value, if you know anyone who might need this, feel free to reach out. You can reach out to me on Facebook. You can join our Facebook group where we again post free content and free information for you so that you can make better decisions and pay less money in tax and overall. Again, if you get value out of this, if you know somebody that might be affected by this, feel free to share it with them. And if you haven't yet subscribed, hit that subscribe button, give us a 5-star rating review. If you're on YouTube, hit that subscribe button. If you haven't followed us on YouTube, do it now. You don't want to miss out on our new content, and you will by subscribing. You will get it regularly by subscribing. And so today's topic, today's piece of advice is a hot topic that people are very emotional about. They lean one way or another, depending on who they listen to and what they've heard. And so I don't mean to stir the pot, but I'm just going to tell you how it is. So today, cash value life insurance. What it is and who is it for and why does it matter? Should everyone get cash value life insurance? If you don't have cash value life insurance and you don't need cash value life insurance, what should you be looking for? And again, I'm not a financial advisor. I'm a tax strategist, a certified tax planner with American Institute of Certified Tax Planners. And it's my goal to just give you more information so that you can make more qualified decisions. So don't take this and run with it and have it be your end all be all. If you're a client, we can talk about this in our tax planning meetings. If you want to be a client, we'd love to have you, or at least see if we have a good fit for your needs, because we're not for everybody. But cash value life insurance is something that is also not for everybody, but it is for certain people. And so we're going to give you the ins and outs of it. And again, this is in addition to all the other information I put out about this topic. We've done interviews and had guests on the show that have talked about it. Most notably is David McKnight, who also wrote a book called Tax-Free Retirement. Great book. Strongly recommend it to further your knowledge on this topic. So what is cash value life insurance? It's an insurance product. It is not a retirement vehicle. It is not an investment account. It insures your life. Cash value life insurance. It can serve as a savings vehicle, but that is not what it is primarily created for. It is primarily created for insurance. Cash value life insurance comes in 3 different product types: whole life, variable universal life, and indexed universal life. Again, there are a lot of emotions in this topic. If you sell whole life or you've read only about whole life, you probably go towards whole life. The same thing goes for indexed universal life. Same thing goes for variable universal life. The difference between the 3, as far as I know, variable universal life is the only one that requires a securities license to sell. So that is completely tied to the market, and you do need further licenses to sell it. You need to meet further requirements, pass more tests. whole life insurance and indexed universal life only require a life insurance license to sell. So what's the difference? Whole life, it's almost like a savings account where you have a fixed interest rate, call it, and it compounds year over year on the amount that is in that cash value policy. Again, it's life insurance, so there's an insurance piece and there's cash value to it. So you can pay the premium every year and you get a certain death benefit that is, it's permanent in nature. So it goes on for the life of the insured, right? Whereas term is only for a specific time, 20 years, 30 years. Whole life and permanent insurance, whole life, variable universal life, indexed universal life is insured for the life of the insured so long as they're paying those premiums. So the option is to pay the premium and get the death benefit for the life of the policy, but you can also contribute more than the premium, and this develops what's known as a cash value inside of that policy. So you can develop this cash value, and this is why it can be used as a savings vehicle. It can serve as a savings vehicle. So you can overfund these life insurance policies and develop a cash value which will receive dividends if it's whole life, and then if it's variable or indexed universal life, it is tied to the stock market. And so then you can develop a cash value and add this to your savings profile. And the benefit comes when you develop enough of a cash value to then take distributions or loans out. And because it's an insurance product, it comes to you tax-free. There's a piece in the tax code, I don't know the section, but it basically says that if you have insurance proceeds, if you have any sort of income that comes from insurance, so long as it's not more than the market value of the thing being insured, then you receive that benefit tax-free. So for my real estate investors out there, when your property goes up in flames and now you have to file an insurance claim and the insurance company pays out and covers the loss that was due to fire, the proceeds from that insurance payout are tax-free so long as it doesn't exceed the market value of your property. And the same thing goes here. You can receive cash from your insurance policy, from your cash value life insurance policy, free of tax. And so people will use this, they'll develop enough of a cash value over a certain number of years, and they'll be able to tap into that and then use that money, which they receive tax-free, and buy a property. They'll buy a cash flowing property, a cash flowing investment. And so I can theoretically have $50,000 in a cash value of my insurance policy, withdraw that or take a loan against that and go and put that down as a down payment to the property that I want to buy. And now my property is cash flowing, which can then pay back the loan that I had in my policy, which is coming to me or my beneficiaries in the form of a death benefit. So it's a great vehicle. I am a strong advocate for it in the right season and for the right person, right? I don't think people who are just scraping by should be having this in their repertoire. Maybe if you want to pay low premiums and you are able to make it work, then you can, but it works best for people who have extra cash sitting around and are just looking for another savings vehicle or looking for tax benefits in the future, because there are not tax benefits in the current year, right? It's similar to a Roth IRA where it's you're technically paying and contributing with after-tax dollars, right? Any premium that you pay to a life insurance policy is not tax deductible and it's used with after-tax dollars. So the first mistake that people make is they think they can write it off, right? I can't tell you how many books that I've reviewed and they have in the line for insurance, and then in that line is life insurance. Life insurance is not a deductible expense, not on the business, and you don't even get it on the personal side. So it does come out of personal funds after tax dollars. It's important for people to understand that, because sometimes you'll go into a meeting with a life insurance broker, and we know some great life insurance representatives, but the idea is that there's some bad actors out there, just like there's bad actors in the tax planning space, just like there's bad actors in the financial planning space, just like there's bad actors in the pharmaceutical space. Like there's bad actors because we all sin and fall short of the glory of God, and evil overtakes us, and some of us more than others. And so we can't let the bad actors express our entire opinion over the entire industry. So there are good actors, and there are people who want to get it right, and there are people who are selling this with service in mind. But the bad actors, what they'll do is convince you that you can deduct it on your taxes, and there's no taxes involved in this transaction, when in reality, taking after-tax dollars and putting it into your life insurance premiums or your cash value. And so it's important for you to get that through your mind. So the second mistake that people make is getting it too early. I kind of alluded to this. And again, with some life insurance salespeople, when you get into the business of life insurance, the first thing they ask you to do is call your friends and family and start to promote it to those people. Tell them what you're doing, and maybe you'll be able to get a product out of it. And so when some people are just getting started, they'll call their other friends who just graduated college and are in their first job, and they'll start selling it or promoting it and advertising it to them. And it is not necessarily the best thing for those specific people, because if I'm in a W-2 job or I'm only making $50,000 a year, then I should not be buying an insurance vehicle that is most beneficial to people who are phased out of typical retirement accounts like the Roth IRA, or even qualified accounts like the 401k or IRA, right? That's insurance works best for people who are making a certain amount of money where they can't contribute to those accounts or they don't want to contribute to those accounts. It's not for the recent college graduate who's in his first job scraping by. And so the second mistake people make is buying it too early. A lot of people are completely turned off to the idea of cash value life insurance because Dave Ramsey has said buy term and invest the rest. And it's largely because that is Dave Ramsey's target market, right? Dave Ramsey's not after the business owner who's making 7 to 8 figures, because that's who life insurance will work for, because you're able to pay taxes and then contribute a lot of money to a cash value life insurance policy. And then year 3 or year 5, you're able to take that money and invest it in your next business venture or your next property. And so don't fall into the trap of writing off cash value life insurance completely, because there is a great benefit for the people that are able. So we don't want to buy it too early, and we don't want to write it off completely. The third piece of advice that I would give is for those who never use it, right? This is a big mistake that people make when it comes to cash value life insurance is they buy this policy, they're paying the premiums, and then they never use it. It's like buying a whole set of books and never reading them. It's like buying another type of car and never driving it. It doesn't make sense. So if we're going to buy cash value life insurance and the goal is to use it properly, then why would we not use it? I know I'm talking to somebody out there because so many people I see are paying premiums on life insurance and they don't know how to use it. They don't know how to use it, or they just choose not to use it. And so those are the 3 mistakes. And I think if you can avoid those 3 mistakes, then cash value life insurance can be a great tool to have in your toolbox. And so then the question is then, who does it make sense for and when do you do it? And I think my piece of advice would be to max out your Roth IRA. And I think David McKnight would give the same advice. You could listen to the episode that I did with him to verify, but max out the Roth IRA. This gives you a nest egg. This gives you the ability to save for the future. You just contribute $7,000 to it, and whatever that amounts to, you're able to tap into that tax-free when you reach the age of 60. Soon after that, look to life insurance. I don't think tax-deferred retirement accounts are always that. I don't think they're ever that great of a benefit. I think they're for somebody as well. You get a tax deduction in year 1, but if you've listened to this, you know that tax rates are the lowest that they've been in history right now. So if tax rates are low, and we know that the national debt is 35 trillion, and we know that the US government makes money by taxing their citizens, then does it make sense to defer taxes now or defer taxes later? And my guess would be most people would be on the defer taxes later, or get tax-free income later, and that comes in the form of Roth accounts or life insurance, cash value life insurance. This is not the end-all be-all. I tell you guys that pretty much every episode, right? I am simply putting it out there so that you guys can have a little more confidence, but if you need more advice in your specific situation, because this is case by case, and I would be hesitant to tell you that cash value life insurance is for everyone. Again, we've talked about the importance of vision, right? We need to make sure that we have vision and we know that where we want to go, and then we make financial decisions based on that vision. If we know that we want to invest in real estate and we know that we want to do it in the next 2 years or next year or this year, then putting money in a cash value life insurance won't make much sense, because you have to wait 3 years for that to start to compound and develop. But if we know that we want to build a little nest egg and save for that property or properties in 5 years, then cash value life insurance could make a great amount of sense. And so it is a case-by-case basis. But I will leave you with this: get unbiased professional advice. We have advised this for many of clients. I've also advised against this for many clients. And so my piece of advice would be find somebody who is unbiased, whose livelihood does not rely upon the sale or lack of sale of an insurance product. That way you're able to make decisions that are calculated, trusted, and you can confidently say, this is the direction I want to go, or that is the direction I want to go. Your life will change. I'm telling you, cash value life insurance is a great opportunity. It offers tax benefits to those who use it properly. But 3 mistakes to avoid would be to write it off completely, would be to get it too early, or would be to use it improperly or not at all. If you can avoid those 3 mistakes and it still makes sense, I say go for it. This has been the Know Your Numbers REI podcast. I am your host, Chris McCormack. I'm a certified tax planner and founder of Better Books Accounting. We've built this podcast and our business to help you, the investor, the business owner, have more confident decisions and more trusted advice. If you got any sort of value out of this, I would so greatly appreciate if you could leave us a 5-star rating and review. If you haven't subscribed to us on YouTube yet, go ahead and hit that subscribe button, hit like, and share it with a friend. Until next time, God bless you and keep moving forward.